You've got a couple of charts here for us. Let's start first with the commodities index. We were just talking about wheat, oil, nickels in there, a whole bunch of different stuff that just seems to be going up into the moon. What is your read on this? Like plus 30% is absurd.
Yeah, year to date. And so, for the 2010s, we had a pretty prolonged period of disinflationary commodity trends, kind of riding on the wave of previous CapEx cycles. And so, following the COVID stimulus and that kind of demand shock that we gave to markets, we started to see rising inflation, right? Inflation was at 40-year highs in November when Powell said, all right, we got to start to get this in check. And recently, and this is something that, no one really could have foreseen, I guess maybe some geopolitical experts, but this hot war that's occurring, really the economic war that's occurring with all the nation states in Russia is just throwing napalm on this inflation crisis. I got a note here: 11% of the global oil supply, 17% of global nat gas, 11% of global wheat, and 10% of industrial minerals are produced in Russia. So if essentially everyone's black mark, just saying, we don't want your commodities, and just kind of holding them hostage, and I think evidently they'll work with China. But there's no way to just snap your fingers and make up that demand in global markets. And so what's the result? Simple supply and demand, prices are soaring. And there's pretty wide implications for that.
When you look at the bond market, obviously that has a huge impact as well as this all plays out. We've seen incredible volatility to the upside to start the year. Similar read on this as well?
Yeah. So, if you think about a fixed income product, right, you're sitting and you're getting a fixed payment in fiat currency. Okay. And so if your goal as a capital allocator is to maintain or grow your purchasing power, bonds that pay a coupon that's above inflation is a good deal. You get a payment, and not only you grow your purchasing power in nominal terms, but in real terms. But if we say have inflation at 8%, and I think these next readings with these commodity markets going parabolic, these next readings are going to accelerate in terms of CPI. And so you're sitting on a fixed income product. What do? Well, you dump it, you sell it. So we're seeing massive volatility in the most liquid markets in the world. Like, people think of equities as kind of the driver, but really behind the scenes, these fixed income markets, these credit markets, really kind of set everything else. And so we're seeing just massive volatility in credit markets. We're almost surpassing the kind of COVID crisis. And so there's trouble, and the plumbing is saying there's something wrong in these global markets, and I expect volatility to actually increase.
Got it. And then when we start to look at the junk in corporate debt, that seems to be in a free fall pretty aggressively. Explain why that's happening.
Yeah, so I've covered this on the past couple of your shows, the previous months, and a lot of people reach out and be like, aren't you kind of interested in Bitcoin? Why the hell are you covering junk debt? Like, who cares? And the reality is, behind the scenes, there's pretty big implications if these things are selling off. So the principal value of bonds is inverse to the yield. So when these things are selling off, right, because inflation's running hot, you own fixed income, you sell it because it's not a good deal anymore. It's not a good bang for your buck. Well, what happens is the yields rise. And so what this means, and we cover this a little bit later, is not only is kind of liquidity draining out of these fixed income markets, but also the financing costs for these corporates is rising in tandem. So not only are these fixed income investors delevering, they're selling, they're getting these off their books, but also you see financing costs really rising across the board for corporates. And so we haven't even really seen that come into play yet. But this isn't just a kind of a corporate debt or investment, junk or investment grade debt corporate thing. This is just basically all fixed income products because, again, inflation is so rampant. And so eventually, and I think what hasn't been priced into markets yet, unfortunately, is that these inflation risks and these kind of the credit sell-off eventually leads to liquidity and solvency risk in fixed income markets, as no one can get cheap financing in a historically over-indebted economy. And so, there's these markets are spelling trouble.
Got it. And so when you start to look at things like the corporate credit spreads, it seems that the drop in the S&P 500 being inversely correlated to these corporate spreads. You've also overlaid here the VIX on top of it. How do you kind of navigate the complexity that's involved with the relationship between these types of measurements or assets?
Yeah. So, why look at these at all? What can they tell you? And so I overlaid corporate credit spreads, which are essentially it's the yield on top of the treasury yield. So the treasury market is that kind of risk-free global fixed income market. It's really still thought of as a global safe haven, despite, a lot of people saying I would never own bonds. It still is that risk-free rate in the global economic system. So we see this corporate credit spread, meaning when this is going up, the corporate credit spread, it means that financing costs for corporates, and this is triple B corporates, is rising farther than that treasury yield. And so that means that it's harder to get financing for these companies. And so overlaying that with the VIX, you can see there's a pretty tight relationship. Obviously, there's a lot of volatility in the VIX, which is a volatility index itself. But there's a pretty correlated relationship between these two things. And I highlighted whenever both of those metrics or indicators are rising, I highlighted what happens to the S&P 500, what happens to equities. So equity market volatility explodes. And it's more so kind of a function of the lack of liquidity in credit markets, which is reflected in the credit spreads. And what happens? The equity indices dump. And so, there's a lot of things happening behind the scenes here. But recently, with, I think the NASDAQ is 20% off the highs. I'm not sure what the Dow or S&P is, but really the credit markets were starting to say there's a problem back in November. And now with all of this inflation happening and the kind of madness in the commodity markets, the equity markets are teetering. I think that's what's going on.
Got it. And so when you start to look at things like the 10-year yield curve, how much are these still like a clean signal for inflation expectations and other metrics versus are these becoming distorted by the complexity of the market?
Yeah, so here we have the 10-year and the 2-year yield curve. So subtract the 2-year yield from the 10-year yield, and you get what's most people refer to, or credit traders refer to as the yield curve. And basically, this indicator, this metric, has predated when it inverts, when it goes below zero. It's called a yield curve inversion. When it's gone below zero, it's predated every single recession since the 1960s. And even before that, it just missed one in the 60s. It was a false signal. Because why? If you think about how the credit system works, most creditors, lenders in the financial system, they borrow short. So like banks, they'll borrow short and lend long. They'll take on short dated liabilities and acquire long dated assets. Like they'll borrow from the Fed for a year or whatever it is and lend for 10 or 2 and lend for 10. So when this yield curve inverts, when you can actually get a higher yield by holding a 2-year treasury note than a 10-year treasury note, there's problems because traditionally that yield curve you'll get a higher yield the farther you go out in duration. So when this inverts, there's pretty big liquidity problems in the market. And so recently it hasn't inverted, but we're seeing a pretty massive flattening of this curve. And it looks like if we kind of just focus on the trend, it looks like an inversion is coming. And this is the crazy thing is whenever these yield curve inversions start to happen, traditionally we've seen the Fed start to loosen financial conditions. But now we're sitting here with raging inflation and a yield curve inversion potentially coming, and the Fed funds rate is still at zero. So truly historic, and honestly, the Fed is completely trapped in what they can do. And I would not want to be Jerome Powell in this situation.
Hey, you, did you like this video? Great. We make 5 of them a day and post them here on this channel. Make sure you subscribe, like the video, and see you next time.